If you run your own business or freelance for a living, you've probably heard the term depreciation thrown around, usually by an accountant or tax software. But what does it actually mean? And more importantly, why you should care? Welcome back to my channel. If you're new here, I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your life, your money, and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out our blog site where we post every Monday, Wednesday, and Friday. Today, we're breaking down what depreciation is, why it matters for your business, and how it can actually save you money on taxes. So, grab a coffee and let's dive in. So, here's the big idea. Depreciation is just a fancy word for spreading the cost of something you use in your business over time. Let's take a quick look at an example of what we mean by spreading the cost over time. So let's say you buy a new laptop for $2,000. You don't use it just 1 year. You'll probably use it for a few solid years. We'll say four years. Well, instead of deducting the whole $2,000 as an expense in the year you buy it, you can spread it out. It'd probably When we look at the 4 years, we take the $2,000 and divide it by 4 years, which gives us $500 per year that we're gonna actually use over time. So, in a nutshell, our yearly journal entry will look like this for the next 4 years until it is completely written off our books. We're going to debit the depreciation expense every year, which is going to hit our profit and loss statement or income statement, and then we're going to credit accumulated depreciation, which is going to be a contra asset account on our balance sheet. So, for all my accounting students that may be watching this, remember you're going to book the entry for what's going to hit our profit statement, and then there's going to be another entry which is going to affect our balance sheet. So the depreciation expense goes out of our income statement as an expense, and the accumulated depreciation goes to our balance sheet as a contra asset account against the the entry for buying the piece of equipment. So depreciation is how we account for the fact that stuff wears out, gets old, or loses value as time goes on. So you might be asking, why does depreciation even exist? Well, depreciation helps your books to reflect reality. Your gear and equipment is going to lose value over time. Your profits look more accurate because we're hitting that expense, and you can take advantage of a tax deduction in the right way. Let's take a look at another quick example just to make sure you understand things a little better. All right, this time I want you to imagine you're a freelance photographer, or maybe you already are a photographer, and you need a new camera and you buy it for $3,000. Alrighty, so what's our entry going to look like? We're going to say that the camera cost us $3, and we believe that this camera will last us for about 3 years. So that's roughly $1,000 over the next 3 years that we're going to be booking an entry. So our journal entry over the next 3 years is going to be a debit to depreciation expense, which is going to hit our income or profit and loss statement. It's going to be an expense on there for $1,000, and then we're going to hit a credit onto our balance sheet for the accumulated depreciation, which is going to go directly against that asset of the camera. And that's going to be a credit of $1,000 because remember, that's a contra asset account. So remember, you'll expect to use it for at least 3 years before upgrading. And instead of writing off the full $3,000 the year you buy it, you're going to spread that cost out over the next 3 years. So each year, you're going to record the $1,000 of a depreciation expense with a debit, and then you're also on the other side for your credit, you're gonna debit a credit $8,000 for accumulated depreciation. So at the end of the 3 years, the camera value on your book is gonna go all the way down to zero. Congratulations, you've written off the full cost, but in a way that matches how you actually use it. That depreciation is not about losing money, it's about matching costs with time. Now, you might be thinking, okay, cool, but why should I care? Well, depreciation matters for a few big reasons. Some of the reasons why depreciation matters and why you should care about it in your business is one, it's going to impact your taxes. So, with that depreciation expense, it's going to kind of drive down your net income, which ultimately will help lower your taxable income. It's also going to show your true profit on your profit and loss statement, With that expense, it's going to show the value of the losing value of that piece of equipment, and show the true profit on your profit and loss statement. And number three, it helps to keep your financial statements accurate. It's like I said, we're keeping up with the time value of how much that piece of equipment actually, its actual value is over time. We're not looking at it at last year, but we're looking at what the impact is today. Depreciation is a tax deduction. You're allowed to claim it every year to reduce your taxable income. Let's take a look at how depreciation and taxes go hand in hand. Here in the US, the IRS sets the rules for how long different assets typically last. So, a few examples could be a computer might, according to the IRS, lasts 3 to 5 years, office furniture around 7 years, and vehicles for about 5 years. Now, sometimes you can actually deduct the whole cost at once using something like the Section 179. That's basically a fast track option that lets you write off the entire cost upfront if it qualifies. It's super helpful for small business owners who want that immediate tax break. But here's what they don't tell you. You have to watch it if you were to sell that asset at a profit. If you sell that asset at a profit, you'll have to repay all of that section 179 bonus and the bonus depreciation that you paid. So you have to really be careful because then you'll be paying capital gains if you sell it before you if you use the fast track. Now, let's take a look at how it affects your profits. Number two, it shows your true profit. If you wrote off the entire $3,000 camera from our previous example, if you remember, in 1 year, it might make it look like that year was unprofitable, even though you'll use the camera for years to come. Depreciation smooths that out, showing a clear picture of how your business is really doing. Now let's take a look at number three, keeping your financials accurate. Depreciation adjusts the value of the equipment on your assets on your balance sheet. So it reflects what they are actually worth today, not just what you paid for them years ago. So your accountant or your accounting software will spread out the deduction over that time frame. Okay, let's just get a teeny bit technical, but I promise, no scary math. There are a few different ways to calculate depreciation. Here are the most common ones you might hear about. So our first method, which is probably the most common and most straightforward and easiest one, is the straight line depreciation. This is the simplest. You spread the cost out evenly over the asset's life. Like the camera example, we spent $3,000 on our camera, so we're taking $1,000 per year for 3 years. Easy peasy lemon squeezy. The number two most popular one is the declining balance or accelerated depreciation. This method writes off more of the cost in the early years because, let's be honest, most things lose value faster when they're new. And then our third common one is units of production. This one is for equipment that wears out based on how much you use it. So think like machinery or vehicles that rack up miles or hours. This one is really popular in the airline industry. These are the main depreciation methods. Straight line is the easiest, just divide the cost by the number of years. Declining balance is the fastest up front, and units of production is used for items that wear out based on how much they are used. Now, the best part, you don't need to do these calculations by hand. Most modern accounting softwares can handle it automatically once you enter the purchase date, cost, and how long you plan to use it. So don't stress over math. Just make sure you track what you buy. Okay, so here's how you could put any of these depreciation methods into practice. Remember, you don't need to calculate these by hand. Most modern accounting software can handle it automatically once you enter the purchase date, the cost, and how much you plan to use. Remember, keep your receipts. Know what your cost is, know the date that you actually bought it, and know how long you plan on using that equipment. And then you're going to want to create a yearly depreciation schedule. It makes it easier if you do it all up front so you don't have to worry about it later. Some accounting softwares can do this for you, where at the end of the year, they'll just add that depreciation journal entry for you for your year end financial statements. Here are 4 tips as a business owner to remember about depreciation in your business. Tip number one, remember to keep records of your purchase. Save your receipts and note what each item is used for. Tip number two, know what counts as a depreciable asset. If it lasts longer than a year, think like a laptop, desk, camera, or a vehicle, it usually qualifies. Tip number three, use accounting software or an accountant. They'll help you to track the depreciation schedule automatically and make sure you don't miss this deduction. And last but not least, tip number four, ask about your options. Depending on your business and tax situation, you might qualify to write off the full cost immediately or spread it out. Either way, you don't want to leave money on the table. So let's wrap it all up. Depreciation isn't some scary accounting word. It's just a smart, structured way to show how your business assets lose value over time and to make sure you get tax benefits along the way. When you buy something that helps you earn income for years to come, whether it's a laptop, a delivery van, or a camera, depreciation helps you match that cost to the time you use it. So, next time you invest in your business, remember, you're not just buying gear. You're making a financial move that keeps paying off over time. If this video helped clear things up, give it a like and subscribe for more small business tips. And drop a comment if there's another accounting topic you like me to explain in plain English. Thanks for watching, and join me again next week to go over how to pay yourself as a business owner.